this chart pattern is setting up pretty interesting. The big scenario, which I've been talking about for a long time, is what happens after this scenario plays out. Now, initially, if we look at the chart on the right edge, you'll notice the stock market starts to fall, gold starts to move higher and really takes off for that big push. And I think gold could have one more big push to 4,100. Eventually, the weight of the stock market moving down will turn bearish and people will start to dump everything, force liquidation. Gold will start to pull back. And if we just keep rolling forward here, you can see how the stock market fell over 50%. Gold got pulled down temporarily. But I believe we're coming into something like this in the stock market, and that's what we need to be aware of.
Gold traders find themselves at a critical juncture as the metal trades within a narrowing channel, squeezed between key support and resistance levels. This tightening range signals an impending move, either a breakout that propels prices to new highs or a breakdown if bullish momentum loses steam. ChrisVermeulen, chief market strategist at the Technical Traders, remains confident in gold's upside potential. He observes that the metal has been consistently forming bullish flag patterns following each rally. If it breaks out from this current pattern, we could be looking at a target around $4,100 an ounce, Vermeulen explains, suggesting a possible 15 to 20% gain from current levels, a significant move by gold market standards. The metal kicked off the week on firm footing, hitting one-month highs across most major currencies. A weakening US dollar, prompted by dovish remarks from a Federal Reserve official and anticipation of President Trump's upcoming tariffs on European goods, acted as a key catalyst. According to Bullion Vault, spot gold rose for the third consecutive week, gaining 1.1% by Monday afternoon in London to reach $3,387 per troy ounce, its highest level since June 24th. Investor caution is building as the U.S. prepares to implement sweeping tariffs of 15 to 20% on European imports. Despite an 83% beat rate in S&P 500 earnings, equity markets are showing signs of fatigue, with recent gains starting to fade. Vermeulen draws a striking comparison to 2007, when stock markets reached record highs, the dollar weakened, and gold surged. He believes gold is positioned for a significant near-term move. It's had a steady run, he notes, but it hasn't exploded yet like silver just did. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
So gold's got lots of potential still. It's been trying to figure out if it's going to put in a top and roll over, but in the grand scheme of things, if we look at price action, we've seen a series of flag pulls in price trading sideways, where price rallies up and then flags, and it's been consolidating. It has a very strong chart pattern here, pointing to about 4,100 an ounce if it does break to the upside. So there's actually quite a bit of upside potential here for gold. I really like it percentage-wise. It is a significant move based on even where it is today after its nice rally. There's about a 15, 20% upside move in gold, which would be a huge explosive move. And that kind of coincides, which I shared with you once before. These two charts here. The yellow line is gold. The one on the left is 2007 S&P 500 stock market top. So the candlestick chart is the S&P 500. The one on the right is today, the current price action. So what's really interesting is the stock market had a pullback and a rally, and then it broke to some new all-time highs. And gold was trading at all-time highs, and it was the number one kind of top performing asset class. Well, we have the same thing happening right now. The stock market has just pushed to all-time highs. Gold is trading in a big bullish pattern. It's one of the top performing assets, and everybody wants it. And then, of course, if we were to actually look at the chart of the dollar, let's go back to 2007 chart and look at what the dollar does. This is the green line. As you just mentioned, David, it's been beat up. It's struggling. It's down today. And more or less back in 2007, nobody wanted the dollar. It was beat up and it had gone straight down. Well, if we look at today's chart where gold is and the stock index in the dollar is crashed as well. It's beat up. Nobody wants it, and everybody's moving into gold and stocks. So we have a very similar chart pattern set up. Different reasons for why it's all happening, but price only goes up or down based on fear and greed. And the charts, that's why I like to look at the charts, to get rid of all the noise, all the news, all the opinions, and just look at price. And either people are bullish for whatever the reason is, or they're bearish. They're buying or selling. And so this chart pattern is setting up pretty interesting. The big scenario, which I've been talking about for a long time, is what happens after this scenario plays out. Now, initially, if we look at the chart on the right edge, you'll notice stock market starts to fall. Gold starts to move higher and really takes off for that big push. And I think gold could have one more big push to 4,100. Eventually, the weight of the stock market moving down will turn bearish and people will start to dump everything, force liquidation. Gold will start to pull back. And if we just keep rolling forward here, you can see how the stock market fell over 50%. Gold got pulled down temporarily. But I believe we're coming into something like this in the stock market. And that's what we need to be aware of. And whether it happens or not, it doesn't really matter, but you definitely need a plan if it does happen. Because if you don't, you're going to really annihilate your retirement, your lifestyle, because all this can happen in like a year, less than a year. And your whole life get turned upside down and your whole life savings can be cut in half. So that's what I'm always talking. That's why I'm always have a bit of a bearish bias. I'm like, you better have a game plan because it's just a matter of time before you kill your retirement. And if the markets keep going higher like they have been, we still use a strategy to follow price higher. So we keep growing our accounts, even if it goes against the bearish outlook that I have. So I would say I'm most bullish on gold. I think only in the next month or two, I think gold is going to have that big run up, a nice rally here. I think gold percentage wise, based on the charts, actually has more to gain than silver does. Silver just had a big pop in the last couple of weeks. It actually just had a nice gain. Right now, I believe the lowest risk play is going to be gold to the upside. The stock market, I think, is on the cusp of stalling out and going sideways and not being a trade anymore for a little while. So I do like gold the best still. And if it starts to break out and run higher here, I mean, it's a great momentum trade for it to run up to about 4,000, 4,100. The charts are pointing to about 8% interest. I'm not saying they're going to go there, but that's what the charts are pointing to. This is a very touchy topic. And anytime I say we're going to have high rates, everybody jumps down my throat, which means it's probably a good possibility because the market always does what most people don't want it to do. But this will obviously crush the United States. This will be a huge problem. It'll probably trigger because of some big external event. People don't trust the United States. There's going to be all kinds of huge problems, and they want huge returns and yields on bonds and things like that for it to be worth to take on that risk. So all the interest rate charts are pointing to higher pricing, and this chart is bullish. So it'll take a long time for it to like roll over and turn down. And so even if rates stay going sideways, David, then bonds are probably going to stay going sideways or work their way lower as well. So it's a kind of a dead trade right now. We have to just wait to see which way interest rates go. Based on that, that'll obviously tell us which way bonds are going to go. And I wouldn't be touching bonds. People are trying to pick a bottom. They have been for a long time and maybe has put in the bottom, but they're wasting years of no real return when they could be somewhere else, like riding the stock market to all-time highs.
Wall Street ended Monday's session with mixed results, as the Dow Jones Industrial Average edged down 0.04%, while the S&P 500 added 0.14%, and the Nasdaq Composite rose 0.38%. Despite the modest gains, market participants remain cautious. With indices hovering near record highs, technical indicators are beginning to signal a potential shift in momentum, prompting traders to reassess their positions. ChrisVermeulen, chief market strategist at the Technical Traders, urges investors to proceed carefully, especially those holding long positions in major indices such as the Nasdaq and S&P 500. He explains that historically, once the Nasdaq gains around 15% following a trend reversal, it often experiences a pullback or a prolonged period of sideways movement. This is usually the point where tightening your strategy is essential, Vermeulen notes, signaling the likelihood of consolidation or correction in the coming weeks. Despite these technical warnings, leading Wall Street firms maintain a broadly optimistic outlook. Morgan Stanley has revised its forecast upward, now predicting that the S&P 500 could reach 7,200 points by mid-2026, a significant upgrade from its earlier projection of 6,500 for the second quarter of that year. According to equity strategists led by Michael Wilson, strong corporate earnings and an approaching cycle of interest rate cuts from the Federal Reserve could support current valuations, which hover around 22 times earnings, over the next year. Jefferies echoes this bullish view, raising its year-end target for the S&P 500 to 5,600 from a previous estimate of 5,300, While some short-term volatility is expected, the prevailing belief among analysts is that broader macroeconomic conditions remain favorable for equities. Let's get back to the interview.
They're continuing to grind and scream higher. We had the S&P 500 breakout. We had the NASDAQ broke out first. And money's really kind of, piling into this market. We went from an oversold bounce. It looked like it was going to be a dead cat bounce. And then it really came to life. It turned into a big rally. And here we are at all-time highs. So it just goes to show you really do have to be dynamic. A lot of people get stuck on you say something, and then people hold you to it as the market changes, and so does the analysis. And it goes from a bounce to a rally to now new all-time highs. You really do have to pivot and shift. You can't hold a thought in your head when it comes to this market. You do have to bend to its will and follow it. So the markets are at a really critical turning point. I mentioned to you just off camera here, there's a couple different camps that are suffering right now from all-time highs being hit kind of week after week, which are the camp of people who are very nervous. They think a big bear market is coming like I do. And they were too nervous to get into the market, even when the trend turned up. And so there's a lot of people missing out. The FOMO is very high. I have what I call an inbox indicator. Pretty much we get a good gauge of how people are thinking and feeling and what they're doing with their money or not doing with their money. And people are very frustrated if you're not long this market. And there's a lot of people who miss this rally. The other half are all the people that thought it was going to sell off and they were more aggressive and they bought inverse ETFs or they bought put options that just keep falling in value. And so both camps are suffering quite a bit. And as I think, a lot of studies show, FOMO, missing out on a gain, is more powerful than actually taking a gain. So every time these markets push to a new high, just like they are today, as you and I are talking, and it's doing it with some power today, there's a lot of pain going on in the markets for, I would say, the majority of aggressive traders or self-directed traders who just don't have a position or are on the wrong side. Yeah, sure. I mean, if we pull up the chart, there's a few interesting things going on right now in the charts on a short-term basis. Let's just take a look at the put call ratio. Now, this is a really messy looking chart, and long story short, there's this little 5-day moving average in the background. And in a nutshell, whenever the 5-day moving average gets down into this lower level that it's hit 4 times in the last month and a half, 2 months, the market tends to stall out. And right now, everybody is very bullish. People are buying call options. They're betting on the markets going higher. So this is a really good short-term indicator. This is telling us, hey, we're probably going to see the market have a bit of a pause or pullback. The other thing that we can look at here is our panic selling and our FOMO indicator. When we look over here, we have this indicator reaching 3, this red indicator. Whenever it reaches one of these levels, we tend to see a short-term pullback in the market. So for example, we got 3 on this indicator, usually means the market's going to want to have a bit of a pullback. We got up to this 3 level over here, the market had a little bit of a pullback. Now these are very short-term signals. It happens over and over again in the market. But what's really interesting, David, is when we go and we look at our sentiment of this market, and this right daily chart of the QQQ, we've color-coded it based on sentiment, what people are thinking and doing. And during an uptrend, typically people get bearish and we get these yellow bars just before the market actually shoots higher. So people get bearish. They think the market's going lower after the big low here after the April sell-off. But the market goes the opposite direction. People get nervous. They decide, okay, market is rolled over. It's going to go down. And then it goes the opposite direction. What's interesting right now is we actually have the market pushing to all-time highs. It's not after a bit of a pullback in fear. And if we actually zoom out and see what happens in a downtrend, we actually tend to see this happen, near a peak, and then the market actually starts to sell off. So we have a couple of interesting things unfolding. I'm not saying to bet against the market. I'm not saying it's going to fall right now, right away, but we do have to be aware that if you are in a position, which we were long the NASDAQ, we closed out at 15% last week. We're still long the S&P 500, but just be aware, we are getting very close. Almost every time the NASDAQ hits a 15% target after one of our trend changes from a bounce to a trend, the market generally will go into a big multi-week or multi-month correction. It might go sideways, it might not pull back a lot, but it will become noisy. And so that's what we're waiting for. And that's what the short-term charts are also pointing to. So those are the things that we're just kind of looking at. This point, you don't want to fight the trend. You got to be long this market. Or I think at this point, if you're not in yet, you're better to still sit on your hands and wait for a pause or pullback to get in. If you jump in right now, I believe you're buying right near a peak, right before we go into some volatility. And the second you buy it, the very next day it's going to drop, and you'll be like, oh, that always happens. But that's because most people trade on emotions. You just have to sit on your hands if you're not in the markets right now and wait for the next opportunity. And that's the nice thing about the markets. There's always going to be another opportunity, just a few, usually a few days down the road or a week down the road. There's always another great opportunity. Well, the opportunity was right here. This based on statistics and based on all the trading of the Nasdaq going back, several decades. This is the opportunity. We just captured that. We've locked it in where our accounts are pushing to all-time highs. Now, when I say it could go higher, it might only go higher 1% or 2 or 3. Nothing life changing before it goes into a bigger correction and it's going to shake the heck out of you, right? So what we go for in certain scenarios is we lock in the trade. After that, if there's a little bit more, we're not trying to get everything out of the market. Now, we are long with the S&P 500. We haven't hit all of our targets yet. We're continuing to let it run higher. So we still have a piece of this, which allows us to be like, okay, well, we locked in a nice gain with NASDAQ. If the markets keep going higher, we still have the S&P 500 in our portfolio moving it higher. So it would suck to be all out simply because then you're like, well, it's in an uptrend and we're out. But the reality is the opportunity, the easy trade, the easy money has happened. And any upside here is really, it's a stretch. There's not a whole lot there. It's not enough for you to gamble and kind of push your portfolio in at this price. I don't really look at earnings at all. I mean, the other day I looked up just the PE ratios of the Magnificent Seven, and it actually blew my mind what Tesla's PE ratio was, considering their stock price has been recently cut in half. It's like 160 PE ratio. And, NVIDIA is only 55, Apple's only 33, and Google was like right down with everybody else, a normal company in the teens, I think. But no, I don't look at the earnings. I got burned really bad years ago. I blew up 3 trading accounts in the tech bubble, buying companies that were growing quarter after quarter. I worked with a company. I paid for their help. We only bought into companies that grew quarter after quarter. And during the tech bubble, even though the companies were growing, we lost everything pretty much. The companies just would fall 50%. They'd fall. I've shared this story with you. Fundamentals and ratios, PE ratios and all this stuff don't really work. If the market is going down and you've got the best company in the world that's growing and earning, it'll still get pulled down with it. Apple was the same. It was like at $106 during the tech bubble and went all the way down to like $4 or $5, even though they had the strongest technicals and they were growing by leaps and bounds. So to me, fundamentals, I throw out the door. We look at price, if it's going up, and if there is enough power behind it. When we look at the money flows, at the sentiment, at where money's going between various assets, if that is really strong and supporting the stock market, you got to be long the market. That's what flips our charts from green to red. It says, okay, well, first we're in a technical trend, and then we have to wait for the stampede or the swell of money to start pushing in that is going to drive the market the rest of the way. Like the big institutions and individual traders, when all they start to flow and drive this market higher, that's when we're like, okay, this is a huge tidal wave. We might as well just jump and play on it and let the tidal wave go until it starts to weaken. So fundamental data, earnings, they mean absolutely nothing for the way that I attack the markets.
When quiet conviction meets structural compression, markets often respond with sharp clarity. Gold's tightening range isn't merely technical noise, it reflects an underlying tension between monetary signals and macro policy shifts. With inflation concerns muted for now, and equities flirting with exhaustion, capital may be scouting its next frontier. Meanwhile, gold's coiled posture and rising resilience in multiple currencies suggest that the next directional move may carry broader implications, not just for traders, but for the financial system's shifting balance between risk and refuge. Is the gold market preparing not just for a breakout in price, but for a breakout in relevance amid a financial landscape in flux? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.